Okay, let's take our conversation forward with Ayaz Motiwala. Ayaz, fantastic to have you back. Ayaz, a question which I'm perhaps asking everyone is that why markets have been so resilient when we all know that the FY22 assumptions will get massively challenged because of the second wave?
Yeah, good morning. I'd say, firstly, I think people are, building up from the last year where in the first 2 months, I think no one had a clue really on how this is going to pan out. And then later, it turned out that this could be probably a 6-9 month, affair, discovery of vaccines, etc. followed. And there's been a sharp rally. So I'm sort of guessing top of the head, people do not want to miss out very, very clearly. In combination with, relative asset class argument and other asset not doing too much, etc. So it's I think top of the head of people is essentially that they don't want to miss out on what's going on.
Is it a good idea to think like this, Ayaz? Because same time last year, yes, when the unlock trade started, demand came back, inflation made a comeback, there was a government support which was there, interest rates came down, the factors were very different. Why are markets thinking then when factors are different, the same kind of a pattern will be at play?
Yeah, one has to look at it on a stock specific or a sector specific basis for sure. If you look at the period gone by as well, in terms of comparing bases and getting fundamental about it, literally 2 months of the last year, first quarter, were kind of completely closed and washed out. So I think market in its wisdom probably might be conjecturing that on that base, we probably will have better numbers. The protocols on treatment, etc., have gone through and are probably potentially having a severe sort of second wave. But I think the way it was or is being handled in terms of the economic activity or the closure of businesses which were done last year as a complete sort of clampdown. This time it's much more measured. So it's I guess, and I'm sort of doing a little bit of a guessing job here that is what the market is basing its wisdom on, that, okay, this is another 6 months that we need to sort of go through and then look ahead. So if at all we want to call it the nascent recovery, where the Q3 and the Q4 numbers, which did not have potentially the low base, particularly Q3, and so the recovery had really set in, even in 20 as such, FY20, which ended in March 20. On that base for Q3 FY21 and most companies in Q4 reporting very decent numbers, shows that the nascent recovery is still at play and across the board. And what we need to base our judgment on is on single securities which are of interest to us.
Have you been shopping or selling in this market, Ayaz? What have been your last key investments in last couple of months?
So, I don't think we've picked on something which has been a revelation and something dramatic, to be very, very honest about it. So it's been more of the same. And we've got some opportunities in sort of the churn that the market is going through, where you clearly would notice that pharmaceutical and consumer companies, whether it's large cap or mid and small cap, are being parted by investors for something which is more moving and exciting at this moment. And that is giving us a chance to sort of, scale up some of the positions which we had let be for a bit for these kind of moments as such. So it's more of, more of the same, if I have to be honest on that. Nothing sort of new which we've done in the last sort of few quarters.
Ayaz, how do you propose one maneuvers ourselves when it comes to FMCG/consumption plays? Off late one has been seeing some delivery-based buying in the likes of, everything from an Asian Paints to a Titan to a whole host of pure play FMCG names as well. But given that this quarter one has already seen that niggling worry of commodity price escalation when it comes to at least FMCG companies and a burden when it comes to their input prices, and also the fact that then the price hikes can only be passed through in a very calibrated manner. It can't be an immediate jump or an immediate pass through of the entire input cost pressures. How do you propose one approaches the entire consumption basket now?
Yeah, so I mean, it is reading some of the some of the input suppliers who are benefiting out of this, and reading that they've probably not experienced such a trend as well. But I'd say on a first principle basis, the degree may vary, but the companies have obviously seen these kind of scenarios in their 20, 40 years of existence or even beyond. So I'd not be overly worried about inflation in general. The way to look at it would be that if there's a particular competitive market where a competitor is doing something different quite dramatically, can afford to do that, has the size, and is going to cause market share shifts, and you tend to own the number 2, number 3 player, then you need to be wary of that fact, where the large player is not going to take on price increases, pass it on to the consumer, and thus try and potentially grab market share. So if I have to construct it that way, it would be really going down to a couple of companies where sort of subsector plays of this type may be at hand. On a general comment, I would I'd say the companies have indeed the pricing power. They've probably benefited last couple of years or even longer of a very benign raw material scenario based on which they've created their franchise, increased their sort of and now it's sort of even out a bit. So I wouldn't get too caught up in sort of worrying about the ability of the companies to do this at the margin, and focus on the core sort of underlying business, which is essentially still penetration and volume growth in India for consumer companies, FMCG companies, including the likes of paints and what have you. So I think that should be the underlying focus. Where is the sort of faster relative volume growth first? Which companies have these solid brands and pricing power to be able to tide over this period? Not for one saying that this is an easy scenario and companies would get over this, but they indeed have brands and pricing power to be able to get over this period. And thus the focus should be on on the medium to long term growth story of these companies.
State-owned sectors, Ayaz, are what is finding favor with the market right now. Many were earlier circumspect and wanted to wait and watch out as to when the first divestment actually kicks off and rolls out, and then perhaps taking a call. But, the market's not waiting for any. In just the last 3 months itself, we've seen a great amount of price action. And in fact, the Nifty PSC has actually been a sectoral leader in that sense, as opposed to various other sectors. How is it that you would approach the state-owned companies?
Yeah, so we've not been, investors in any of these kind of companies, including the banks, where I think essentially, in terms of our orientation, it is about, a good business. In most cases, these businesses are, sort of, commodity driven or, including, financial services being the big chunk of that index, or an industrial company or two. And these are not, classically value-creating businesses where they are making, more than the bank rate, forget an excess return. So that itself is a business criteria is sort of not being met in terms of our threshold on what we expect on returns on capital for a business atypically. And then it comes down to, how they are run and for whose benefit they are run. So it's all very nice to say when the stocks run like these, and we tend to forget the periods of 5-8 years or even longer, where earlier the charts of those same stocks were shown as underperformers over a decade basis. So I think we'd not want to miss out on that aspect of it, that these have been not sort of great value creating businesses from a shareholder value creation perspective. And, that is, firmly, embedded in our heads. And so we, like anybody, would be tempted by, these kind of sort of exciting returns, but then are reminded of our sort of long-term journey. And so we want to, stay the course, be on that path of compounding our wealth and value creation through high-quality businesses.
Fair enough. Commodities, Ayaz, that's really where so much of the action has been in the last 3 months. Where do you stand on that? What's your outlook on that pocket of the market?
Yeah, so we do own a few of these in terms of sort of derivative plays as benefiting out of these commodity sort of trends. One of them being a company called Orient Refractories, which we owned and written about and own it for a while now. So as you know, sort of refractories are, a direct play on steel volume production, so to speak. And thus, as we see this step-up cycle play out, where, first the steel companies are benefited by the export initiation or the local demand, the nascent recovery that I talk about, essentially giving them a lot of breathing space, making sharp improvements in their profitability. This would lead to the sort of second stage where actually volume growth and volume production sort of kicks in. And some of these companies that we own, and we call them sort of quality cyclicals, if you will, should be the beneficiaries out of this. I mean, there are kind of refractory companies, there are ball bearing companies, or there are a company like AI Engineering, etc. So we think this is our way of trying to participate into some of these businesses, which will have a sharper recovery, and as noticed from the past 5 and 10 year cycles, their sort of amplitude of change is far more dramatic than the pharma and the consumer type businesses. So in a portfolio construct, we do have a few of these to benefit out of this change potentially, which is coming up, along with other actions that these individual companies are taking in terms of being the export hub from India, because the Indian steel base is large itself at 110 million tons per annum. So those combinations will add a few more points to the long-term growth expectations that we have out of these companies.